This is such a proud of Cirrus Research. The latest issue of Risk Metrics is just out. The Metrics report is a look at cross-market relationships along tactical elements. For instance, what are risk appetites like? Are markets crowded? What are credit comparisons going across regions? These things tend to drive massive sways in running an active portfolio. The title of this issue is Easing Capital Markets and Risk Signals Favor Asia. We call out this data, and here we're looking at credit markets by region. And the thing that I think is pretty incredible is not that the US credit markets, the credit spreads in the US currently high yield market, they're at 30-year lows in terms of their comparison. But the thing that's really, really impressive is how the rest of the planet's credit markets are now converging with secular lows in the US. This is a very pro-cyclical call, and it's very counter to this consensus currently that's building that if the Fed is cutting rates, we are likely slowing and potentially going into a recession. It's very counter to that. In fact, most of the House view in our recent outlook suggests that the risk is not necessarily a downside risk, but effectively the upside risk, which is potentially a bearish steepener. So this credit comparisons in Asia, I think, is important because what it does is if you go back a couple of years ago, it relates, let's say, the real estate crisis and everything else going on in China and how it spread across the region. But what's material is that before the Chinese policy was enacted recently with adding liquidity to the system, what we're seeing is that institutional investors have been rallying these spreads 6 months in advance. So I think this is critical. Another key item here that allows us to focus on Asia is to look at risk appetites globally. Risk appetites are effectively on their heels. For whatever the reason, risk measures have become very defensive. There are some exceptions like India and the UK, but for what we're seeing, most of these circles, which represents markets, they are left justified, which is much more of a risk-averse world. Risk appetites tend to be contra signals, so effectively this is suggesting that when investors are back on their heels, that is genuinely more of a pro-risk posture, not defensive. And then finally, we've argued in the past months that as Japan enters more of a tightening cycle as they try to counteract inflationary pressures, which is very different from the rest of the planet where central bankers are cutting rates, this is effectively putting more of a defensive press on Japanese equities. We have noticed that a more defensive run has occurred. The problem with that is we're now looking at leadership baskets that are very crowded, probably the exception compared to most other parts of the planet. Something to look out for, which is that when you get crowded markets, leadership signals tend to become very erratic. So if you're a momentum investor in Japan, be careful here. Take a look at the full report, and as always, happy to take your questions.